Thank you, Sylvester, for this very kind introduction. It's a great pleasure to be here at Tilburg University, one of the leading centers of thinking about economics and finance and management in Europe. And I also want to thank the Van Lanschot Bank for sponsoring this wonderful event. The title of my talk today will be Global Imbalances, the Financial Crisis, and the International Monetary System. I will focus on the European situation. Europe, of course, finds itself at a historic juncture, in particular this week and this month. But I will also try to put the European problems in a broader context, because my belief is that the Euro crisis is very much related to a broader crisis in international financial relations, a crisis which, of course, manifested itself in the 2007-2009 events, which led to the greatest worldwide recession since the Great Depression of the 1930s. In outline, I will talk about three topics today, and in light of the urgency of the European issues, I'll probably try to move quite quickly through the first two. I want to illustrate what will be well known to some of you, some of the new patterns of financial globalization as they've evolved over the last couple of decades. And next, topic two, talk about some of the new external vulnerabilities which these have generated. These are primarily issues for the advanced countries, but they will also increasingly affect the emerging markets as the world economy evolves. And finally, I'll apply some of these insights to talk about the vulnerabilities of the Eurozone and some of the larger lessons for the international system. So, topic one. Since the beginning of the 1990s, around the time that the Maastricht Treaty was signed, the process of international financial globalization has accelerated dramatically. And this can be seen in two aspects of the data. One of these is the dispersion of national current account deficits, the current account being the difference between national saving and national investment, closely related to the balance of trade. In addition to the dispersion of current account imbalances, however, there has been an explosion in the level of gross assets and liabilities. And for some countries, this explosion has been truly exponential, as I'll illustrate in some of the data below. Now, the current account balance, the saving investment balance, is also equal, as a matter of identity, to the difference between countries' gross acquisitions of foreign assets and their gross sales of liabilities, their gross liability issuance. These gross flows are much larger than the net flows, as I'll illustrate. In addition to the flows through the current account, however, the evolution of net international investment positions, gross assets minus gross liabilities, is also affected by capital gains and losses on these gross positions. And these changes in net international investment positions have become much more volatile and much larger, so that the current account is much smaller as a fraction of the net international investment position. The picture of global imbalances, or of current accounts, is well known, and this chart illustrates how they've evolved since the mid-1990s. And you can see here quite easily the large U.S. deficit that opened up through 2006, and large corresponding surpluses in other parts of the world. These current account balances have to add up across the world to zero, because one country's borrowing is necessarily another country's lending. The picture of gross asset positions is, if anything, much more dramatic. So in this picture, I show the sum of countries' gross assets and liabilities relative to gross domestic product. And you can see that for some countries, the numbers have increased since the mid-1990s, and especially since the mid-2000s at startlingly large rates. The numbers for Switzerland are legendary and were reflected in the problems that Switzerland had at the time of the financial crisis. The balance sheet of Union Bank was much larger than Swiss GDP, which caused great problems for that country. The UK is shown in black. The Netherlands would be in this category, more or less, if I showed them. And the Eurozone as a whole is smaller, but still, toward the end of 2007, its financial openness measure, as shown on the vertical axis, is approaching 4 times GDP. So these are very large positions that countries are taking. And my contention is that these positions also carried with them fairly large risks. Now, in the Eurozone, we see a microcosm of the current account developments. Here I show current accounts not in absolute terms, as in my last slide of current accounts, but relative to GDP. And you can see what happened since the inception of the euro was also a big dispersion of current account balances. Greece's borrowing, to take one prominent example, reached about 15% of its gross domestic product. Germany, as a counterpart, was running large surpluses, and some of the other countries that now find themselves in serious trouble, or that may soon find themselves in serious trouble, Portugal, Spain, Ireland, also developed large current account deficits during the course of the 2000s. And I would maintain that these were serious danger signals which should have been attracting more attention from the part of EU policymakers than they actually did. The position of gross assets, I will try to skip over more quickly since time is limited and I'd like to focus on the Eurozone. But I just show you the very dramatic position of Ireland. I assume all these slides will be up online later if you want to review them. Here I showed separately the gross assets, the gross liabilities, and the net position. For Ireland, gross assets, gross liabilities, even in 2007, were about 13 times Ireland's gross domestic product. The net position, the difference between these two, is not very impressive, whereas for Portugal and Greece, it reached a very large and dangerous number equal to about 1 times GDP. For Ireland, these gross positions were enormous, and even though the gross positions of institutions really relevant to the Irish economy are significantly smaller, those were still multiples of GDP. And when the Irish government stepped in to guarantee bank liabilities, thus turning a banking problem into a huge fiscal problem, the Irish economy was thrown into the crisis in which it now finds itself. Well, these sorts of numbers lead to, I think, new views on external vulnerability, which are very sobering indeed, in my opinion. Now, traditionally, in thinking about international financial crises, starting in around the mid-1980s, which coincidentally is the time when Portugal wound down its earlier standby arrangement with the IMF, we thought of crises mainly in terms of emerging markets. True, we had the Eurozone, the pre-Eurozone EMS crisis in the 90s, which was quite big, but didn't really evolve into a full-scale financial crisis as the emerging crises did. And the emerging market crises were much more in the category of twin crises, banking plus currency, or triplicate crises, banking, currency, and fiscal/default crises. In line with this development, the IMF, from the mid-1980s on, became a lender primarily to emerging markets and developing countries. The idea that advanced countries, rich countries, might have to turn to the IMF became a distant memory until Iceland went to the fund at the start of the most recent global crisis. And it was, of course, followed by Greece, Ireland, and Portugal. So the newer view of crises following those events thinks about the possible implications for richer countries. It thinks about the possibility of capital gains and losses on the net international investment position, which in turn are driven by these very big gross positions. And it looks at the possibility of broader balance sheet crises, which you can think of bank runs essentially on an entire country. We saw things like this in Asia in the late 1990s, but now we've seen it in a sample of richer countries, not all of which are countries in the Eurozone. And I believe that the broader applicability of this balance sheet crisis phenomenon is a fact that policymakers will have to contend with going forward. Well, let me first say something about the net international investment position and the way that large gross positions cause it to change. So here's the example of the United States. I show in red financial flows, essentially the current account in red, as I said, and then the total change in the net international investment position in green. This change basically results from the red financial flows and also a valuation component, which is shown in blue. And you can see that through the course of the post-1990 period, these international investment position changes come to dominate, come to be very large, much larger than the financial flows, and come to be dominated by the valuation component. What is going on for the United States is that the U.S. Has liabilities that are denominated in dollars, assets that are denominated in dollars, but also largely in foreign currencies. When the dollar depreciates, the U.S. has capital gains on its foreign assets and nothing on its liabilities, because these are dollar denominated if we measure these gains and losses in dollars. As the positions grow in magnitude, even with the net position remaining unchanged, the potential for very large gains and losses becomes essentially unlimited. And just going back to that earlier slide, you can see that in the financial crisis, the U.S. First had huge losses, approaching $2.5 trillion. Then these were quickly reversed. And these were associated with the dollar's appreciation in the crisis, also with changes in bond prices, changes in equity prices. So the U.S. is a particularly dramatic example, but these factors are also at work for the smaller countries. Think of Portugal, which is one of the crisis countries, and in 2009 still ran a current account deficit of 10%. You would think that its net foreign liabilities rose, but they actually decreased in that year. The net foreign assets divided by GDP rose by 2% due to various valuation changes on gross assets and liabilities, which for Portugal are actually quite extensive. Why this is the case, I've been trying to figure out, and it's not a straightforward question. I've even communicated with former high economic officials in Portugal, and they can't figure it out. So what's going on, we don't really know. But the numbers are very big. 10% of Portugal's GDP is a very, very big number. Current accounts, I would argue, still matter for various reasons. Just thinking about the U.S. fiscal situation versus that in Japan, both countries have large debts. Japan's is much, much larger. Yet Japan is not in a fiscal crisis. Why is that? I think the position of the current account is important. If Japan had to close off its markets in a financial crisis, it would still be able to draw on the pool of domestic savings. If the US had to do the same, it would be unable to draw on foreign savings, which it currently relies on. I think this is a major issue in thinking about the solvency of the respective governments, the respective fiscal positions, and therefore I think the current account position still does remain very important. But we still have to think about the entire balance sheet of an economy when we think about the consequences of a cutoff in lending. The U.S., again, is an example. We think of the U.S. or thought of the U.S. as a country that was largely immune to this sort of sudden stop crisis, the sudden stop in foreign lending that afflicted emerging markets and that still potentially afflicts them. But in the case of the U.S., there actually was a sudden stop after the Lehman collapse. The U.S. was able to liquidate foreign assets, though, to finance its current account deficit needs and also to finance Federal Reserve swap lines, which shunted money to the European Central Bank and other foreign central banks. Large foreign asset positions have to be analyzed, have to be looked at by policymakers, are important in analyzing the effects of credit market disruptions, and also, I believe, carry certain perils. And these are perils that we can very much see in the current Eurozone situation. Larger leveraged positions imply larger counterparty risks. Again, it's not enough to look at the net position of a country, because the net position is the sum of many gross positions. If some of your institutions have large debts, others have large assets, it's the debts that are going to become important in a crisis. So we need to know the distribution of possibly heterogeneous holdings. This is a big challenge for the data that regulators have and the data we collect, but it's very important. In addition, we think in the current situation, look at Ireland with its very high rate of deflation, that debt devaluation of the type that Irving Fisher talked about in the 1930s could be very important. Ireland is having a big deflation. It also has big gross debts. There's a transfer from debtors to creditors in deflationary circumstances, and this transfer is larger the larger are the gross positions. The large gross positions imply large redistributions from debtors to creditors. In a situation of debt crisis, this can be very damaging, as Irving Fisher pointed out many years ago. We see this in the Eurozone. We've seen it in dollarized economies, which try to adjust by devaluing their currencies. And finally, these large gross liabilities are what the state may have to assume in bailout situations. Ireland, again, is the leading example. But again, think about the situation of the Greek government. The Greek net debt is not as large as the gross debt, which is the number we focus on. Greece has assets, but these assets can't easily be realized. We have a debate over privatization, and meanwhile, the debtors, the gross debtors, have to be paid. The gross debtors are the ones who are demanding the cash flow, the coupon payments, the principal repayments. So again, gross debt is important. The fact that the Greek government owns public utilities is not that helpful if the Greek government is unwilling or unable to realize the proceeds of selling those public utilities. And that's not an easy process because people work for those public utilities. They're demonstrating in the streets. So there we are. Gross assets are what we have to look at. So this is a very big problem. What is the answer in terms of insurance for countries? Well, in the slides, I talk about some of the proposals that are on the table to provide better insurance mechanisms. I talk about the international reserves that countries have accumulated, particularly in the emerging world. I think these reserves carry with them significant risks. Just to give you an idea of the magnitudes, relative to GDP of the emerging and developing countries, gross foreign exchange reserves have grown to about a third of their GDPs. These are remarkably high numbers, especially when you reflect that the emerging markets are pretty much equal in magnitude now to the developed markets in terms of their contribution to world product. Here's a picture showing current and forecast shares of emerging and developing economies relative to GDP. You can see that around 2008, these shares measured at purchasing power parity became equal, and the IMF forecasts that the emerging share is going to be continuing to grow. So these are very large numbers indeed. And they raise questions about the stability of the current international reserve system. Essentially, international reserves are supposed to be safe assets. The safe assets are the liabilities of the governments in the advanced countries. In the Eurozone, some of those liabilities aren't looking so safe anymore. Similarly, one can raise questions about the US, the UK, but as the emerging markets grow, where will their demand for safe reserves go? In what assets can they invest as they grow to be larger than the advanced world? You know, ultimately, if the US, say, continues to issue government debt, its so-called safe government bonds will become unsafe, and then we run out of international liquidity. So the international liquidity problems of the global economy, I believe, deserve a more coordinated response than they have received. And I'll come back to that at the very end, because as we've seen in the Eurozone too, there's a big question of where liquidity comes from in crises. And the solutions so far that have been put together have been extremely ad hoc. Okay, well, let me talk about the Eurozone in the remaining time. The period after the founding of the euro in 1999 was, I think, a quite exceptional period in the evolution of the world economy. The preconditions that were set down then, I think, had a very big impact in setting the stage for the global financial crisis of 07-09, but they likewise had a big effect in setting the stage for the current difficulties of the Eurozone in a number of ways. One very important issue was the behavior of real interest rates in the Eurozone. Now, this type of phenomenon was predicted by Sir Alan Walters in around 1990. He was Margaret Thatcher's chief economic advisor, and he argued against the UK entering the exchange rate mechanism on the following grounds. Countries that enter a credible currency area will find their bond yields converging to the common level. But some of those countries will have greater inflationary pressures than others. And in those countries, real interest rates, the difference between nominal bond rates and expected inflation, will be lower. Those low real interest rates, in turn, will spur consumption and spur inflation, leading to even lower real interest rates in a destabilizing pattern. I will illustrate what happened in the 2000s, which bore Walters out. What he didn't emphasize as much was the fact that should deflationary pressures arise, the similar destabilizing patterns would occur, and they might even be augmented by rises in sovereign spreads. Just to illustrate this pattern, here are the real interest rates, as I've calculated by proxies, in the Eurozone, and you can see how in all of the crisis countries, as well as Italy and Spain, these rates declined relative to Germany's real rate of interest over the 90s. And we have to remember that after 2001, roughly 2000, 2001, the period of the dot-com collapse, this is superimposed over a picture of declining real interest rates in Germany and the rest of the world. So the great boost to aggregate demand in these peripheral Eurozone countries is quite remarkable, and it helps explain the very large current account deficits that they ran. Now, of course, the counterpart of these inflation rates, which were relatively high in the peripheral countries, is a loss in competitiveness or real appreciation compared to Germany, which I illustrate in this picture. Ireland here is the most extreme case until the crisis, when Ireland embarks on a big deflation. And this is the sort of converse of the Walters critique, that in a currency union, once countries get into a deflationary situation, as Ireland has, their real interest rates can become very high, reducing activity, increasing deflation, and leading to yet higher real rates of interest. And that's really the story in Ireland here. This is what happens to its real rate of interest in the recent data. Now, associated with this loss of competitiveness and these high real interest rates are, of course, the large current account dispersions that I showed you earlier, the euro area imbalances, the global imbalances within Europe, as it were. And here we see, very heavy borrowing by the peripheral countries. What happened in these countries, very contrary to what was intended by the founders of the Eurozone, was that the ability to consume way above income and to keep consumption standards artificially high removed the strong pressure for restructuring, for labor market reform that was argued would be forced by the common currency. If you remember the debates about the Eurozone in the late 1990s, the European Commission in various studies said, well, if there's no devaluation option, labor market flexibility will necessarily come about because that will be the only way for countries to maintain their living standards. Well, we had in the Eurozone a phenomenon that we also had in many other countries. We had it in the US, we had it in Eastern Europe, we had it in Iceland, very, very high consumption, fueling large current account deficits, financed at low interest rates, sometimes supported by housing booms, as was the case in Spain, US, UK, many other countries. But all of this borrowing made restructuring not such a priority, and it just didn't happen. Right? Portugal grew very slowly. Nonetheless, Portuguese consumption grew faster than Portuguese income, so everyone was happy. No problem. Let's borrow and spend. This ended up to be a very toxic mixture for the world economy. It first crashed in the global crisis of 07-09, which started when the US began to unravel. But inevitably, countries in the Eurozone that had followed similar strategies, that had failed to restructure during good times, were stuck in bad times with large debt burdens, large external liabilities, uncompetitive real exchange rates, and what we've seen is really a throwback to the bad old days before the Eurozone. One of the big, let me just skip ahead, indicators of this is unemployment. Okay, so look at Spain. There's, back before the euro was launched in the mid-1990s, Spanish employment rates hovered around 20%, the highest in Europe. The boom associated with both global liquidity in the 2000s and the transition to the euro pushed Spanish unemployment down below 10%. It looked like Spain's unemployment problem was solved. Well, it was really only disguised. And now Spain is back up to a 21% unemployment rate. These are IMF projections, by the way, after the current year, and I think the IMF is probably being pretty optimistic about the prognosis given current data. So this is a huge vulnerability, but these vulnerabilities were always there. So how did things unravel? Well, Ireland, if you looked at Ireland's fiscal accounts, it didn't look like it was doing too badly. but its housing boom and its lending boom were incubating a huge banking crisis. When Ireland assumed the gross liabilities, some of the gross liabilities of its banking sector, it was thrown into crisis. And the initial austerity that Ireland undertook was widely praised, but it helped slow the economy down, helped worsen the banking crisis by worsening the housing crisis. Greece is a very different story. It's a story of government overborrowing, which is now causing problems. But these situations with high debt, in a situation where devaluation is not possible, such as Ireland, Greece, and Portugal, made countries vulnerable to a different sort of crisis, not a currency crisis, but a sovereign debt crisis. And the logic of this had been made clear in the literature, had been seen in cases such as Argentina's, but became particularly virulent in the cases of these Eurozone countries, simply because the markets allowed them to accumulate so much debt. I mean, Argentina's debt could never get as high as Greece's debt was allowed to get, as Portugal's debt was allowed to get. The mechanism is basically simple. To pay off the debt, the government has to generate primary budget surpluses. It has to tax more than it spends. If markets feel this is unlikely to happen, they fear default. The greater probability of default leads them to charge higher borrowing rates. These borrowing rates worsen the deficit and require larger primary surpluses, which are even less likely to be produced. Therefore, borrowing rates rise even more. And eventually, you have a very quick vicious circle in which multiple equilibria can arise, in which essentially the phenomenon goes from being a liquidity problem to a solvency problem. Now, of course, with the right policies, a virtuous circle can also result. And there have been some of these in recent history. But how to get there is a art rather than a science. The specific features of the Eurozone, I think the euphoria of the irrevocable currency, the growth boom, led to countries such as Greece getting far more extended than was prudent. And the markets, allowed them to do so. Regulatory regime allowed this to happen. The collateral policies of the European Central Bank also promoted this. So a familiar story. But to make matters worse, in the case of Greece, even the data were wrong. Just between October 10 and April 11, if you look at the revision in the IMF's forecast, you see that the forecast was revised not only in the future, but in the past, back to 2003, because new debt appeared, new debt that nobody knew about, that was totally off the books. So this was a very grave situation indeed, and now the Greek debt is basically coming to be 160% of GDP. Now, this is not a situation of liquidity crisis at interest rates above the rate at which the German government can borrow. This is a true crisis of solvency. These debt levels created huge vulnerabilities. There were other vulnerabilities which I've touched on. The way that financial regulation was left by the Maastricht Treaty was noted by many at the time to be quite problematic. Essentially, the ECB was put in charge of monetary policy with a price stability mandate, but its role as a lender of last resort and the ability of any centralized institution, let alone the ECB, to regulate or supervise the financial institutions that might need lender of last resort support was left completely undefined. I believe it was left undefined because of another issue, another weakness that has been very much discussed recently, which is the ability of the Eurozone countries to pool resources for fiscal support of financial institutions and for fiscal support of sovereigns in financial crises. Of course, the latter being ruled out by the Maastricht Treaty, but still, still nonetheless happening out of necessity. If there had been some centralized supervisory authority, perhaps with the power to handle cross-border resolution of failing banks and so on, it would have needed fiscal resources. Nobody was willing to discuss that, to put that on the table. At the time, some countries were barely being brought along into the process. The German public was skeptical. The French narrowly rejected the treaty in a referendum. The idea of fiscal transfer union, even back then, was a taboo subject. And so you couldn't really centralize too much in the Maastricht Treaty. But I think these gaps have come back to haunt us. Which brings us to the case of Greece and what to do now. The Greek situation is truly a tragedy, and it's hard to say, at what point the tragedy could have been averted. I think as is usual in Greek tragedies, there are many participants in the tragedy, and they all, bring it about in a sort of inevitable way as they try to escape the cruel hand of fate. And I think this was, so many times in Greek history, default, became inevitable given the institutional setup. Last night, or I should say very early this morning, the Eurogroup finance ministers postponed the issue of short-term and long-term finance for Greece as they wait for the Greek Parliament to decide on the future of the Papandreou government and the future of an austerity package. I think if you had been informed on January 1st, 1999, that more than a decade later the Eurozone would be hanging on these decisions, I think you would have been amazed. First, you would have been amazed that Greece was in the Eurozone, probably, but it's a completely remarkable outcome. And I would still say that this is not. It's not necessary for us to be in this position, or for you to be in this position at this point. I think one has come here through a series of very short-sighted policy decisions that have, brought us to what may be another short-sighted policy decision this week. This refinancing will also involve supposedly voluntary rollovers by some of the financial institutions and pension funds that are holding the Greek debt. We don't really know how or if that is going to work, and whether that will be declared a default event by the ratings agency. So, what is sort of waiting in the wings is very, very difficult. I think that a outright default by Greece would essentially bankrupt the Greek banking system. Much of the debt of the Greek government is held by Greek banks. And the Greek government would, in that situation, be unable to finance its primary deficit. It would need to recapitalize its banks, but lack the resources to do so. And I think then there would be two, basically the Greek government, as the government of California has on a couple of occasions, most recently in 2009, would issue its own paper to pay public employees to keep basic services running. And then the situation would be quite chaotic. There would be basically two options at this point. The EU could step in and support Greece, or Greece would be forced to exit from the euro. And my belief is that the spectacle of Greece exiting from the euro and the disruption that would cause, not least in contagion to countries like Portugal and possibly Spain, would be a big deterrent. So I think that basically, even in a default situation, the European governments, the European partners would be forced to put up a lot of money to run Greece, to keep Greece a going concern within the Eurozone. So let us not think that default is necessarily going to take the Eurozone governments off the hook in terms of providing finance. If they want to keep Greece in the Eurozone, as I think they must, they have to keep providing the money. What are the other options? Well, really unclear. One option, and I think this something like this is hinted at by the outgoing governor of the Lanschot Bank a couple of days ago, is to vastly increase the resources that are being put into stabilization. At this point in time, it looks like Spain is becoming much more fragile. I think any bond investor looking at the demonstrations over the weekend has to really ask, what is the prospect for those primary surpluses to be coming? And Spain has other vulnerabilities. Its local authorities are running arrears in their payments. The cajas, the saving banks, are facing potential balance sheet problems in light of what is going on in the Spanish housing market. So again, it's a very fragile situation. So I think the EU ministers should be thinking of radical solutions. A default, moreover, would have other implications, not just for contagion. It would trigger credit default swaps. We don't know really what the distribution of those gains and losses would be. Banks outside of Greece would face losses, so there would be contagion of that sort. It's no wonder that even the United States is very worried about the possibility of a Greek default, because it would have wider repercussions. I think in the end, the EU will continue to support Greece, and I think the EU has to think about whether this support should come in small amounts with each installment preceded by some sort of crisis, or whether the Greek debt should just be removed from the markets, basically guaranteed in some way that allows the EU to impose conditionality on Greece without the specter of a default every time. I mean, make no mistake about it, at this point in time, the EU is the hostage of Greece, because Greece, if it doesn't get the money, defaults. And that's a credible threat. If Greece doesn't have the money, they default. Game over. So will the EU allow this to happen? Well, think about what happens if the EU defaults and then Spain is next. That's a lot of money. So at the end of the day, it would be better, I think, to get this threat off the table and then deal with Greece by controlling the checkbook. It's hard to imagine that this would occur in the current political environment, but I think something like that is the safest answer for going forward. Can restructuring of some sort be part of the process? Maybe yes, maybe no. I don't think that has a major implication for the ultimate financial contribution that the other Eurozone countries would have to make, or for the adjustment that Greece would have to make, unless this restructuring is very, very big. And if that happens, then money will have to be put into the game by recapitalizing some of the European banks outside of Greece. But it's really a no easy solution situation. And, I would favor something decisive, clean. Of course, at that point, the leaders of the other Eurozone countries will have to, educate their publics about what they're doing and why. And they may suffer political consequences, but, leaders with courage have to sometimes do that. Okay, is the Eurozone doomed? Well, I believe it's not necessarily doomed. I think at the end of the day, the costs of a breakup in terms of, Europe's position on the world stage are very dire. And, I like to believe that Europe will not allow itself to be set back in this way. But again, this will require more cooperation and courage on the part of the the current leaders. Now, a big problem here is to recognize that any solution may involve moral hazard. Now, of course, Greece is not having a particularly good time at the moment. I don't think future governments will necessarily want to emulate what is going on there, and there's really no path for Greece that is painless, and maybe that will be deterrent enough. But I think that in thinking about moral hazard, it's not enough to think about the Greeks. It's important to think about the entire structure of Eurozone governance. What is the attitude toward current account flows and other sorts of financial excesses? Because there were lots of warning signals along the way, and we all know how and why they were ignored. So let me conclude by coming back to the original setting of this lecture, which was in the broader world economy, including countries outside of the Eurozone with floating currencies. While we see a particular problem of the Eurozone here, I've tried to draw some parallels and some interconnections between the Euro crisis and the global financial crisis. Many of the same factors were at work in the global financial crisis, the large gross positions, the large flows from European banks into American asset-backed securities, the large global imbalances, and the contagion, which we fear in the Eurozone, certainly was present in the global financial crisis and prompted extraordinary actions by central banks, extraordinary levels of international cooperation, which I think were very important in containing the crisis. As in the Eurozone, the broader world economy needs to think about the mechanisms of liquidity support, both for sovereigns who get into trouble and for financial institutions that need lender of last resort. And these must come with supervision and surveillance functions that are centralized in a way that maintains uniform regulations and requirements across countries, and that provides some sort of break on the moral hazard that results when there is a readiness to put central bank support and fiscal support into containing financial crises. We've learned a lot about the international monetary system over the last decades. In 1973, when the present system came into being with the demise of the Bretton Woods system, when most countries, most of the larger currency areas went to floating rates, when Europe started on its separate route, which eventually led to the common currency, we thought that floating exchange rates could bottle up policy misbehavior, allow countries to be independent. Europe wished to be more interdependent, to have a common market, and it was thought that once fixed exchange rates were put into place, structural problems would wither away and the monetary union would function smoothly as a common currency area. We've realized now that neither of these predictions has come true, and a prime reason for this has been the process of financial globalization. It has created risks and interdependencies that policymakers ignore at their peril. It has created opportunities in situations of high liquidity for countries to avoid precisely the kind of restructuring that they needed to make the Eurozone work smoothly and to build up large debts that became huge liabilities for the stability of the entire Eurozone when the business cycle turned harshly from positive to negative. Whether these problems can be addressed in the coming years will require much more joint governance and resource pooling at the Euro level, but also, I believe, at the global level. The same sort of problems are certainly qualitatively present and will require vision from national leaders everywhere to resolve favorably. I'll stop there.